In project finance, the providers of debt capital, the banks and other financial institutions, they make their decision as to the amount of debt funding they will advance and the terms attached to this primarily based on the cash flow that the project is anticipated to generate. That is absolutely key. So the collateral value of the underlying assets in the project company are actually secondary. The main credit consideration is the cash flows, specifically the cash flow or the free cash flow that the project will generate. Let me illustrate this with a simplistic example. If you're seeking to buy a house, the bank will assess the size and stability of your monthly salary. They may look at what your other debt obligations are, and then they'll offer you a mortgage bond, or what we also call a home loan. Now, the thinking of the bank when they lend you that money is that you'll be able to pay the money in monthly repayments for, let's say, 20 years. Each month, you'll pay an amount, some of which will go towards interest, some of which will go towards repaying the original loan amount or the principal. The bank is also thinking that in the event that you default on your home loan, they are legally entitled to repossess the house, sell it, and recoup how much is owed to them. So banks generally have a high degree of confidence that they will recover their money on a home loan. With project finance, it doesn't work that way. The focus is on the free cash flows that will be generated by the project. Why? Often if you take a look at the underlying asset, it is very difficult to liquidate if there's a default. If, for example, a project company owning a power plant defaults on a loan, how practical is it for a bank to seek ownership of that power plant and then to sell it? What if the owner of the project company is the government? It becomes very unrealistic to seek to liquidate the underlying collateral. So prior to investing, the providers of debt capital will seek to get a high level of assurance that the free cash flow of the project company can service and repay the debt obligations. So emphasis again, with project finance, it is cash flow based lending. And the free cash flow generated by the project determines the bank's appetite to lend money to the project and the attached terms and conditions.